welcome to Investors Hangout. This is the 175th episode. We began way back in October 2016 and it's been a wonderful journey with the support of our viewers. This weekly interaction is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Does the recent market fall and the fear of recession make you anxious? Are you wondering what to do with your investments in such a scenario? Watch today's episode because today we have with us Mr. K.S. Rao, Head of Investor Education and Distribution Development at Aditya Birla Sun Life AMC Limited. Mr. Rao is also the one who came up with this idea of Investors Hangout way back in 2016. I think it was pretty ahead of times. Welcome, Mr. Rao.
Thank you so much for having me here. Thank you.
We are also joined by our CEO, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
All right, Mr. Rao, let's start with you. It has been a rough patch for equity markets lately. Fear of recession mounting, inflation going up. So in such a scenario, what does your experience say about investors' behavior?
Yeah, thanks, Ruchira, once again. Thanks for inviting me to this special episode. Indeed, it's a pride. And I take this opportunity before starting the question, answering the question, to compliment and congratulate Dhirenji and the entire team for their commitment to empower investors week on week. And of course, at AVSLMF, we take the pride. This is the initiative, which is an industry first, and using the Hangouts way back in 2016. And I'm so glad to see we have empowered millions of investors through this Hangout. And of course, with the rich and relevant and right information week after week over the years. And it is, I'm glad it is moving up, and it's the way we have engaged is very neutral. And kudos to Dhiren for this. And coming back on the question, and why someone is investing in equity is the question we need to ask. Investors are investing in equity for higher returns, and higher returns will always come with a higher risk. And today's investor looks more mature, and they have become legendary. Having understood the volatility, retail investors started saying put, and we can see the trend from Amphi data and also the growing SIB book. I quote Seth Klarman. Once he said, "The stock market is a story of cycles, and human behavior is that responsible for overreaction on the both directions." And in the current scenario, what you need to do is stick to the basics: faith, patience, and discipline, three qualities to achieve superior returns. And one should not get panic and exit equities completely. Rather, one need to systematically step up investment over a period of time during this correction.
All right, Dhirendra, what would you like to add here? How should investors react in such a situation? What should they do?
Of course, investors should be doing the simple things. We might sound like a stuck record that if you're a long-term investor, hang on, do nothing. Carry on with your investment plan, keep calm and carry on. But, it's much easier said. I would like to tell I would like to deal with, or tell different kind of investors differently. There are young investors who started in the last 1 or 2 years, and they thought that the market only goes up. They are witnessing this big decline in a brief period of time for the first time, and their reaction will be very different. Then there are old investors who also came in the market for the first time. They will be behaving differently, because they will be risk averse. They will be more concerned because of their age. They might be thinking that this loss might become permanent, and that is true. This loss will become permanent if you panic. So you have to really quickly take a stock that did you accidentally drifted into the market, and if you just came for the quick money, then I think that was a wrong starting point. You should quickly take a stock, meet some advisor, meet some distributor, try and figure out that what is going on, what has happened in the past, how you should react to this. And I would like to give some guidelines here. One is that all young investors who came in the last 2-3 years, which a lot of them came, they should just stop looking at the values every day. If this is your money, if this is the money which you are investing, which you are unlikely to need for next 5 years and more, just forget about it. If you are an old investor and if you are likely to need this money in 5-7 years time, and you are simply concerned that it has gone up, all the gains got wiped out so quickly, don't get out in a huff. This happens. And look at the opportunity loss. If your opportunity cost is just about 4%, 5% that you would have got in fixed income, that rate of return will keep coming down. In the case of the situation that the environment that we see now, With high inflation, you need to earn more return. That is more important today, because otherwise your money will lose value more sharply. So my only so I would like to broadly differentiate that investors who came accidentally and they are not long-term investors, they should get out of the market. And if you are a long-term investor, you did not have a plan, you somehow came into this and you are getting worried about it, get some advice, stop looking at the values every day, and stick to your plan.
Mr. Rao, what's the role of asset allocation in such a scenario?
Yeah, I think I agree with Dhiren. What he said is right. During these volatile times, one need to stick to the basics, and that is the most important one. And it is always said, what matters to the wealth creation is not timing the market, but the timing the market. And investment journey is long with multiple pit stops, and goalposts keep shifting, and so the circumstances, and likewise the current conditions of the market. And the highly effective strategy at this point of the time is sticking to the asset allocation, and it's asset allocation is core for a successful investment journey. And of course, the continuous process is to reevaluating and rebalancing the portfolios. And asset allocation always helps to minimize the risk and optimize the return, and it reduces the volatility in the portfolio. Let the investment portfolio be based on the goal based investment, and sticking to the goal based investment and the duration of investment according to the goals. And that's the way people can look at not at the market volatility, but look at investment as a whole, like I call it as an IPS, investment philosophy statement one should have with themselves.
All right. And do you think it's time for investors to scale back from equities and probably invest more in fixed income instruments?
There are two ways to look at Ruchira. I mean, fixed income as a portfolio you allocate doesn't mean that you need to go back and redeem the equity, but you can enhance your fixed income allocation in the current scenario. It looks like we are going to get back with the rising interest rates, and if we can get there, probably the portfolio can have a little better returns. Maybe current market correction is due to three things, right? Rising inflation and anticipated interest rates hike, and of course the expected, some people speak about the recessionary trends. And based on this, one need to invest in the time frame, stick to the equity, and any redemptions from equity may not be advisable. Rather, you need to step up into the equity. And and until and unless somebody's goal is very shorter and they need money quickly, instead of redeeming, you can have opt for SWP, systematic withdrawal plan. And if you have a long way to invest and long way to go for your investments, invest more, and invest more with us, we call STP, so you can systematic transfer plan, and there is a step up SIP. You can use the step up SIP for this.
But Dhirendra, even the debt market is not doing so well these days. So what should investors do with their fixed income allocation?
No, a lot of investors are fixed income investors only primarily, and quite understandably. So I would say that investors should not think in terms of in a binary way. Fixed income investors should err on the side of caution, because interest rates can go up higher, can go up once again. And if that is and we don't know when it will happen. We don't know whether it will happen, and we also don't know when it will happen and what will be the pace of it. And so with that in mind, I would say that investors should not get venturesome with fixed income. They should primarily stick around the short-term funds, and retain their focus on quality, because the high quality funds, and there are easy ways to figure this out. Keeping your universe limited to ultra short-term bond funds, and making sure that you're investing in funds which are dominantly investing in AAA and substantially, because these funds, to optimize return, will have some allocation to non-AAA as well. But this is also the time when investors still have fresh, and with fixed income you don't take chances of the kind that you take with equity. So have your asset allocation, as Mr. Rao said. Make sure that you are sticking around short-term bond funds, and don't lose focus on quality.
What do you think about gold? Gold is generally considered a safe haven for investors, and also whenever global economies are down, gold tends to do well. So should one allocate some portion of their investment to gold?
Yes, it is a completely it's not a correlated asset. So in that sense, it has gained prominence among advisors that have allocation to gold. But I'm not a very strong believer of that, simply because it's not a productive asset. But there have been situations, there have been cases, or there has been a context when gold has come out, has looked very impressive. In 2008, when we had the global financial crisis, equity was tanking or was falling so freely, and fixed income was defaulting. We had big investment bank collapsing, and that was the time when gold actually was going up and was able to withstand all the madness that we saw in the market. So with that in mind, I think gold turns out to be a great safe haven when everything else fails. So with that in mind, someone can have some allocation, but as a long-term large allocation to gold, I don't think it is a very wise thing to have any significant allocation to gold.
All right, now before we sign off, can I request both of you to please give a list of do's and don'ts for investors in such a market scenario? Mr. Rao, why don't you go first?
Thanks, Ruchita, once again. And probably I can stick to what I said earlier and what Dhiren was reiterating time and again. Having asset allocation is the key. I call it the edge of asset allocation creates the wealth. That edge for me is EDGE. That is, you should have an exposure to your equity. You should have exposure to your debt, probably some extent on the gold. And the last E I call it is the real estate. Together, it can make you less vulnerable. And second part I can talk is bear markets are considered to be always, we think it is little fearful, but they are the most friendly markets to create a wealth, because this is the time you acquire more and you can reap more. And third is a goal based investment is always a proven method. Stick to your goals, don't look at the markets. Markets will do its own duty. I know markets will go up, down, and stable. And during last 175 episodes, if I go back and rewind, I can see many ups, many downs, and many times there is nothing is happening. And the fourth one is right financial advisor can always contribute in this journey, and which can help substantially to manage your own volatility of the mind. And the last, since I said the mind, investor behavior is the key and is the essence. I think Benjamin Graham, who said the investor's chief problem and the worst enemy is likely to be himself or herself. And investing is not a number game, but it is a mind game. And stay invested.
All right. Dhiren, what's your list of do's and don'ts?
No, my list will be, very much, if I have to compliment what Mr. Rao has said, that, you have to do very few things in investing. First, have the foundations, which is have the health insurance, life insurance, if you have dependents. Then have the emergency fund so that you really don't panic. Because the moment you have the foundation, you can actually plan ahead. Invest your long-term money into equity. And then comes a lot of don'ts, because the list of don'ts about investing is much longer than the do's, because the do's, you have these 5-6 things which can take care of it. Don'ts, which is a huge distraction, because sometimes you will have a crypto, sometimes you will have the market, sometimes you will have the recession, sometimes you will have the inflation. So I would say that don't be guided by the noise. Everything else is a noise, and you will be trying to guess you will try to time it. You will regret that why did not you get out of the market 3 months ago, or why did not you invest 10 years ago. So those are quite understandable things. Don't have any of those regrets. Have this simple set of things to do, and make a long list of things which you should never do, and it will look like a very tempting thing to do, because many a times your biggest enemy is that you will be tempted to invest in crypto. You will be you will be tempted to invest in something which has done very well in the recent past, and it will collapse soon after you invest. And that is the nature of the that's the character of the whole investment segment that we deal with. So have a simple plan, stick to it, and don't look at the outcome for next 2-3 years. And I don't think you need to really come back to us for any reinforcement.
Well, with that, it's a wrap. I think it was a great roundup of all the 175 episodes that we've had so far. A list of do's and don'ts, and Thank you, Mr. Rao, for joining us.
Thank you so much.
Thank you, Dhirendra.
Thank you.
Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.